I want you to think about the last time you watched the finance video, or read a finance article, or followed someone on social media who posts about stocks. There was probably a portfolio breakdown, maybe some hot stock picks, definitely some talk about doing your research and finding the right opportunities. And somewhere in all of that, there was this implied promise that if you're smart enough, disciplined enough, willing to put in the work, you can beat the market. And here's the thing. That promise feels good. It feels right because you're smart. You do put in the work. You read the articles, you follow the earnings calls, you watch the charts, and you genuinely believe that effort, that intelligence, that diligence has to count for something. But what if I told you that the overwhelming, documented, statistically humiliating evidence says it almost certainly doesn't? What if I told you that most professional investors, the ones with Bloomberg terminals and Ivy League degrees and teams of analysts and access to information you will never have, don't beat a simple index fund over time? Not because they're bad at their jobs, but because of something far more fundamental than that. Today, we're going to get into what I call the embarrassing math of investing. And I promise you, by the end of this, you are going to look at your portfolio or the portfolio you're building completely differently. Not because I'm going to tell you something discouraging, but because understanding this changes everything. And the people who understand it build more wealth with less stress, less risk, and less time than almost anyone else. Let's go. Okay, so let me tell you about a bet. A real bet. One of the most famous bets in the history of investing. In 2007, Warren Buffett, the most celebrated investor alive, made a public wager. He bet $500,000 that a simple S&P 500 index fund would outperform a hand-selected portfolio of hedge funds over the next 10 years. The other side of the bet was taken by a hedge fund manager named Ted Sades, who was so confident in the world's best active fund managers that he put real money where his mouth was. 10 years later, in 2017, the results came in. Buffett's index fund had returned approximately 7.1% annually. The hedge fund portfolio, about 2.2% annually, after fees. The index fund won by a lot. And the hedge funds on the other side of that bet, they were not random bad funds. They were selected by professionals, managed by professionals, overseen by professionals. Let that sink in. The smartest, highest paid, most well-resourced investors in the world, with every tool, every analyst, every piece of data available, lost to a fund that simply buys every stock in the S&P 500 and does approximately nothing else. Now, you might be thinking, okay, but that's hedge funds. I'm different. I do my research. I pick carefully. And I hear you. I really do. Let me show you why the problem goes even deeper than hedge funds. Here's a number I want you to genuinely sit with. According to the SPIVA report, S&P's own annual study comparing active fund managers to their benchmarks, over a 20-year period, approximately 94% of actively managed U.S. large-cap funds underperformed the S&P 500 index. 94%. That means if you walked into a room of 100 professional fund managers, people whose literal career, whose livelihood, whose professional identity is picking stocks, and you asked which ones beat the S&P 500 over 20 years, roughly 6 would raise their hands. 6. And here's the kicker. You don't know which 6 in advance. Nobody does. And the ones who did beat the index in the last decade? Research by S&P shows that past outperformance is not a reliable predictor of future outperformance, meaning the 6 who raise their hands this decade are probably not the same 6 who raise their hands next decade. So the idea that you, a retail investor, doing your research on evenings and weekends, competing against teams of professional full-time professionals, can reliably and consistently beat the market, the math is not generous. But look, before we go further, I think we need to understand why this happens, because it's not just about intelligence or effort. There's something structural going on here, something almost invisible, and once you see it, you cannot unsee it. Let me give you a metaphor. Imagine a poker game. You sit down at the table, you're a decent player, you've watched tutorials, you've read some books, you understand the hands. And across from you are 6 professional poker players who do this for a living. You have the same cards, you play the same game. But here's the thing the casino doesn't advertise. Every hand you play, you're paying a small fee to the house just for being at the table. And the pros aren't paying that fee, or they're paying a much smaller one. That's the market model. Every time you trade, every time you buy or sell, you're paying friction, commissions, spreads, taxes on gains. And the market is not a charity. Every dollar of outperformance someone earns comes from someone underperforming. It's a zero-sum game before costs. After costs, it's negative sum. This is what William Sharpe, Nobel Prize-winning economist, laid out in what he called the arithmetic of active management. Before fees, the average active investor must earn exactly the market return, because they, collectively, are the market. After fees, the average active investor must earn less than the market. Mathematically, always, without exception. The only way to escape this math is to be consistently above average, but not just above average by more than your costs, which for a retail investor with taxable accounts is extremely difficult to pull off consistently over decades. Now let me introduce you to the real villain of this story, because it's not intelligence, it's not effort. The real villain has a polite-sounding name. It's called fees. Here's the thing about fees that most people don't fully understand. They sound small. A mutual fund charges 1% per year. An advisor charges just 1% on assets under management. What's 1%? That's basically nothing, right? Wrong. Catastrophically, embarrassingly wrong. And here's why. Imagine you invest $100,000. Over 30 years, the market returns 7% annually on average. With zero fees, your $100,000 grows to approximately $761,000. Now add a 1% annual fee. Your net return drops to 6%. Your $100,000 grows to approximately $574,000. The difference between those two numbers is $187,000. 1% fee, 30 years, $187,000. That's not a rounding error. That's a second retirement account. That's a down payment on a house. That's real wealth that silently and invisibly moved from your pocket into someone else's. And it gets worse, because the fee isn't charged on your profit, it's charged on your total assets. So as your account grows, the dollar amount of the fee grows with it. In your final years, when your account is at its largest, you're paying the most in fees, in absolute dollars, precisely when the compounding is most powerful. John Bogle, the founder of Vanguard and the person who created the first publicly available index fund, called this the tyranny of compounding costs. He spent his entire career trying to get people to understand that the cost of investing is not incidental. It is the single most controllable variable in your long-term investment outcome. Let me give you the real comparison now, side by side. A low-cost total market index fund, something like Vanguard's VTSAX or Fidelity's Zero funds, has an expense ratio of approximately 0.03 to 0.04% per year. That's 3 to 400th of 1%. On a $100,000 portfolio, that's $30 to $40 per year. The average actively managed mutual fund in the United States charges approximately 0.66% per year, according to Morningstar's 2023 data. Some charge 1, 1.5, even 2%. And if you add a financial advisor on top, charging their own 1% advisory fee, you're looking at total costs of 1.5 to 2.5% annually. Now remember, professional fund managers underperform the index before fees about half the time, and after fees, the math swings dramatically against them. So you're paying more for worse results on average, not in theory, in the actual documented tracked data. Here's where it gets a little uncomfortable, because I know a significant number of people watching this are paying an advisor or are in actively managed funds through a 401k or IRA. And I want to be careful here, because I'm not saying advisors are scammers. I'm not saying active managers are evil. I'm saying the structure of the fees, even with completely honest, well-intentioned professionals, produces a mathematical headwind that most investors don't consciously account for. And here's the specific thing that bothers me. Most people don't know what they're paying. A 2020 survey by Personal Capital found that 46% of American investors didn't know what fees they were paying on their investments. Nearly half, paying for something, probably significantly, and not knowing what it costs. So here's the simplest, most powerful thing you can do right now. Go look at your fund's expense ratio. It's on every fund's fact sheet. It's on Morningstar. It's on your brokerage platform. Find every fund you own and look at that number. If it's above 0.10%, you have a very good reason to ask whether the expected performance justifies the cost. Spoiler, most of the time it doesn't. Okay, now I want to tell you about behavior, because here's the part that almost never gets discussed. Even if you could find the fund that beats the index before fees, even if you were brilliant enough to identify it in advance, there's another force working against you, and it might actually be more powerful than fees. It's called the behavior gap. The behavior gap, coined by financial planner Carl Richards, refers to the difference between what an investment actually earns and what the average investor in that investment actually earns. And the difference is consistently staggering. Here's how it works. Markets go up over time, but they don't go up smoothly. They lurch, they correct, they crash. And human beings, wired by millions of years of evolution to run from danger and chase rewards, respond to those lurches in predictable, terrible ways. When markets go down, investors panic and sell. When markets go up, investors get excited and buy. This is the opposite of what logic demands, but it's exactly what our emotional wiring drives us to do. Buy high, sell low. Repeat, regret. According to research by Dalbar, over the 30-year period ending in 2022, the S&P 500 returns an average of about 9.65% per year. The average equity fund investor earned about 6.81% per year, a gap of nearly 3% annually. Not because their funds were bad, because they kept moving in and out of them at the wrong times. Let me put that 3% gap in concrete terms. On $100,000 over 30 years, 9.65% returns compound to approximately $1.59 million. At 6.81%, the same investor ends up with $710,000. The difference, the behavior gap, cost them $880,000. Nearly $1 million of wealth destroyed not by bad investments, but by bad timing decisions driven by emotion. This is why I think the index fund is not just a financial product, it's a behavioral weapon. Let me explain what I mean. When you own a total market index fund, you own a tiny slice of every publicly traded company in America, or the world, depending on which fund you choose. When one company goes bankrupt, your fund barely registers. When a new company explodes in growth, you already own it. It was in the index. You don't have to make decisions about which stocks to pick or when to rotate out of sectors. You buy, you hold, and you let the compounding do its work. And because you're not actively trading, you're not generating taxable events. Every time you sell a stock at a profit in a taxable account, you owe capital gains tax. Index funds have extremely low portfolio turnover. They don't sell much, which means they generate far less in taxable capital gains distributions. Over decades, tax efficiency alone adds a meaningful percentage to your actual after-tax returns. Here's the thing I want to say clearly, because I think there's a narrative in the investing world that goes, index funds are for people who don't know what they're doing. Real investors pick stocks. Real investors beat the market. And that narrative is backwards. It's completely, provably, embarrassingly backwards. The people who most aggressively advocate for index investing are not people who gave up. They are people who understood. Jack Bogle understood. Warren Buffett understood. And has said publicly multiple times that when he dies, his instructions to the trustee of his wife's inheritance are to put 90% in a low-cost S&P 500 index fund. Not in Berkshire Hathaway, not in hand-picked stocks, in an index fund. The greatest stock picker of the 20th century is telling you to index. Eugene Fama, the Nobel Prize-winning economist who literally developed modern understanding of how markets price information, spent his career documenting why it's essentially impossible to consistently beat the market after costs. His work, called the efficient market hypothesis, is not universally loved, but the core evidence behind it, that markets incorporate publicly available information into prices rapidly, is about as well supported as any finding in economics. Now, I know some of you are going to push back, and I want to address the most common pushbacks because I think they deserve honest answers. Pushback 1. But what about Warren Buffett himself? He beat the market for decades. Yes, and he has also said publicly that he cannot replicate what he did in the past in today's market with the capital he manages today. His early returns were driven by access to deals, negotiations, and strategies unavailable to retail investors. His extraordinary results over his full career are an outlier, and he himself will tell you that. You are not the 1 in a billion exception to the statistics, and neither am I. Pushback 2. But I personally made great returns picking stocks last year. Possibly true. Also, possibly explainable by the fact that in a rising market, almost everything goes up. The relevant question is not whether you made money. The question is whether you beat the index by more than your costs and taxes consistently over a decade or more. Very few people have, and the ones who think they have often haven't done the honest accounting that includes their losers, their timing, and their actual after-tax, after-fee returns versus the benchmark. Pushback 3. What about small-cap stocks, international markets, real estate? Fair. There are submarkets and asset classes where persistent outperformance has been more documented. Small-cap value stocks, for example, have historically provided premium returns over very long periods. But here's the thing. The best way to access these premiums is still low-cost, diversified index funds targeting those specific factors, not individual stock picking. The tool is still the index. The application is just more specific. So, what do you actually do? Let me give you the practical framework, because understanding the problem without an action plan is just anxiety. Step 1. Know your costs. Open your brokerage account right now. Find every fund or investment you hold. Look up the expense ratio for each one. Add up the total annual cost as a percentage of your portfolio. If your blended expense ratio is above 0.15%, that is your first problem to solve. Step 2. Simplify. You do not need 10 funds or 20 stocks to be diversified. A 2-fund portfolio, a total U.S. market index fund and a total international market index fund, gives you exposure to thousands of companies across dozens of countries. A 3-fund portfolio adds a bond index fund for stability as you approach retirement. The complexity you think is protecting you is often just costing you. Step 3. Automate. The behavior gap is not caused by stupidity. It's caused by emotion operating in real time. The cure is removing real-time decision-making from the equation. Set up automatic monthly contributions, automatic reinvestment of dividends, automatic rebalancing if your platform offers it. Make the system do the work so your emotions don't have to. Step 4. Stop watching. I mean this. The single most counterproductive thing most investors do is check their portfolio too frequently. Checking your portfolio daily or weekly increases the probability that you see a short-term loss, that your loss aversion instinct fires, and that you make an emotionally driven decision that costs you years of gains. Set your contributions, set your allocations, and check in quarterly at most, maybe twice a year. Your money needs time more than it needs your supervision. Step 5. Give it time. This is the one that can't be hacked or shortcutted. The compounding that makes index investing work is not visible in months. It's barely visible in the first 5 years. It becomes remarkable in years 10 through 20 and genuinely extraordinary in years 20 through 30 plus. The investors who fail with index funds almost always fail because they didn't give the strategy time. They bailed during a crash. They checked out when the gains felt too slow. They switched strategies midway. Let me close with the number that should anchor everything else I've said today. If you invest $500 per month starting at age 25 in a low-cost total market index fund, earning the historical average market return of approximately 10% nominally, you will have approximately $2.9 million at age 65. That's 40 years of consistent, boring, automatic investing in something that requires no stock research, no market timing, no prediction, no Bloomberg terminal. The vast majority of people who spend their investing lives chasing outperformance, paying higher fees, taking on more concentrated risk, burning hours on research will end up with significantly less than that. Not because they're unintelligent, because the math was always working against them and they didn't know it. You know it now. The most powerful investing strategy ever discovered doesn't require you to be brilliant. It requires you to be consistent. It requires you to be cheap. It requires you to be patient. And it requires you to resist the very human, very understandable urge to do anything when markets get scary. You can do all of those things. You don't need a license. You don't need a degree. You don't need access to special information. You need a low-cost account, a broadly diversified index fund, an automatic contribution, and time. That's the entire strategy, and it beats nearly everyone who does anything else. So open the account, set up the contribution, pick the fund with the lowest expense ratio, and then go live your life. Because the most valuable thing you can do for your investments most days is absolutely nothing at all. If this changed how you think about investing, or if it confirms something you already suspected, share it with someone who needs to hear the math. And if you want to go deeper on building a simple, low-cost portfolio from scratch, understanding tax-advantaged accounts, and automating your wealth building, subscribe. That's exactly what we cover here every week. See you in the next one.